I'm good, I was need, I died, I was need, I was dying, I was need, I died, I was need, I was dying, I was need, I died, I was need, I was dying, I was need, I died.
Everybody getting signed on here with us. This is Everybody Please Meet Andy Mulholland. He does a lot of our groups and a lot of our friends' P&Ls and their bookkeeping. He by far has been one of the most important additions to our service provider list because this is an area that I pay zero attention to. And the main reason is it's so damn time consuming and it's so incredibly cumbersome, and it doesn't focus on any of the lead indicators. It's a lag indicator. So for me, it's not sexy. It's not fun. None of us like to see the transparency into our numbers. However, getting transparency into our numbers has allowed us to make decisions in our business based on the financial health of our business, which I think is where a lot of us need to focus. And we see it all the time. I hear people talking about their profit margins, and you hear people talking about apples to oranges comparisons when they're looking at true P&Ls and how an agent should run it in order to have the transparency into their business. And Andy's company, it's called Simple Numbers. They do this for us on an automated basis. It's unbelievably affordable. And I was paying my accountant to do what he did, but I was paying my accountant like $800 an hour to do it. So it was an obscene amount of money for a service that should be done on a monthly basis. So Andy, I'll let you go ahead and kick it off. Guys, if you have any questions, feel free to type it into the chat and we'll get rolling.
Yeah, thanks, Colton. Appreciate the intro and obviously your trust and us handling all of your stuff for you and so many people within your group there. It's been awesome to do that. And what I think one of the benefits I've had, it's one thing when I was building my real estate business and I had a team, pretty good sized team in Minnesota, and financials were not something that I looked at very often. But even when I did, I only had an understanding of my financials. And now I see so many financials every month. And it's brought a lot of insight to a lot of what Colton was talking about. It is if you're feeling overwhelmed, if you feel like I don't pay attention to this enough, if you're feeling like I don't even know what it means when I look at it and it just drives me nuts, nothing seems to add up, it doesn't make sense. You're not alone. I was right there with you for a lot of years. And I think a lot of teams are. And so my goal today for you guys is to help you as you're meeting with your bookkeepers, as you're meeting with your CPAs and getting a handle on last year's numbers and either planning for this year or just really deciding if there's any major changes you need to make in your business, that you understand what your P&L is telling you about the business. So I'm going to help you break it down into what we call the simple numbers. There's 5 of them and we're going to go through them. And I'm also going to help you kind of frame your mind in how you need to look at your numbers. I think a lot of times we look at things a little bit incorrectly. And so I'm going to talk to you about that as well, as far as the lenses in which we see our financials. So let's get into it. So yeah, as Colton said, we're Simple Numbers. A lot of you already have bookkeepers that you trust that do a good job. I think some of the keys you got to have in place with bookkeeping is they got to get you your numbers regularly and timely. You've got to have your books within the first 2 weeks of every month to look at the previous month's numbers. If that's not happening for you, you got to get on your bookkeepers. If you're not getting them the information they need, make sure that that's happening, because each month you guys should be looking at your financials briefly. A lot of our clients use CTE and or CSU, and we upload a lot of the financials into those platforms so that they can just use that to review their financials. That's the way I did it, using CTE in my real estate team. I didn't want to get into the actual P&L necessarily. I just want to be able to look at CT and tell me what my margins were, or CSU, or whatever other platform you might be using to track things. But Simple Numbers is our business. Obviously, if you need help in any of this, we'd be happy to talk to you about that. But today's call is all about helping you guys get a grasp on kind of what's going on in the business. As Colton mentioned, I did start a real estate team. Just so you know, that's one of the things that I think people have found helpful with us is I understand the business. I'm not a details person. I'm a high-level business builder. And we did that with our real estate team in Minnesota, and had a lot of success with that business. It allowed me, I've got 4 kids. My wife, Ellen, who's also involved in Simple Numbers, she was the CFO of our real estate team. And so we've just translated the things that she's done into Simple Numbers. And now we do it for others. And so we travel a lot. We've got a big RV that we love to travel over the country with our 4 kids. And we live in Minnesota still part of the year. And we've got a place in Phoenix, Arizona that we spend quite a bit of time in as well. So if you're ever in that area, I'd love to talk to you guys more down there. But there came a point in my business that I needed help, right? When I sat down like these two folks and I looked at my numbers, I got super frustrated. It didn't make sense to me. And most importantly, I didn't know what the numbers were telling me about my business. So that's what I want to get into with you guys today. You guys need to make sure that, especially if you're building a team, I don't know how many on the call are team leaders versus individual agents, but this becomes even more important once we start building a team. You have to have an economic model. You've heard the old saying, Jim Collins, I think who said, begin with the end in mind. I did not do this early on in my real estate business. And I remember the first time I really understood my financials, it was not a pretty picture. And some of you might be in the same position I was, where I was starting to bring on agents, admin expenses, and all of these things. And I was making less money and spending more time running my business than I was when I was just a high producing individual agent. We have to, and I wasn't getting any time back. It's one thing to sacrifice some profit for time, but I wasn't getting that. I was doing more deals personally when I was still in production in my team and making less money. I think that year I did 800,000 in GCI alone, just me, and my company netted 600 grand. The year before I was netting what I was making in GCI or very close to it with minimal expenses. So I had the wrong economic model. What's your model? If you aren't crystal clear, I call it your pie, your model. If you aren't clear on what your margins need to be, what you're shooting for, then I want to help you do that today on the call. You've got to walk away with some understanding of what your model looks like. The worst thing you could do is build a model that you didn't intend to build, like I did, because I had to basically blow up my team and start over. And it's painful. Okay, but some of us get there. So economic model, I didn't even know what that was for a lot of years, but once I got a grasp on it, it made sense. So before I get into how you need basically the 5 simple numbers, before I break down your profit and loss statement for you, I want you to understand how to look at your P&L. In other words, like your frame of mind around the P&L. Oh, Megan, you said you helped me change my economic model at B-School. Yeah, that's awesome. I appreciate it. I remember talking to you and kind of working with you on that stuff. I ran the boardroom group at the Real Estate Business School for a lot of years, and Megan was part of that for some time. So thanks for the comment there. I want you guys to know that there are different ways in which you need to look at your books. When you meet with your CPA, they're going to have a different lens in which to look at your books than you should have as the CEO or CFO, right? The IRS is going to look at your books differently, right? So that's the first lens, is how is the IRS going to look at your P&L? Well, obviously they're looking at it for how much you should be paying in tax. They want to know that you're paying your fair share. They want to know that they're getting what they are owed, and they can come after you, like in this picture. And this is obviously a joke, but they can come after you if you're not doing that correctly. The next lens that will review your P&L is your accountant or your CPA, right? They are going to look at it from a CPA's perspective. Well, what is that? Their job is to cover their butt. So they're going to make sure you don't do anything you shouldn't be doing in your P&L as far as deductions go. But they're also going to make sure that you deduct everything you can. At least a good CPA will. If you don't have a good one, let me know. We can always refer one to you. But they're also going to make sure that, they don't get in trouble if you get audited. They're going to cover their butts. Here's the problem with those first 2 out of 3 lenses is they're not looking at your P&L like a business owner. They're not looking at your P&L to say, what does this say about the health of my business? You don't know how many times I've had CPAs tell clients, oh, your business was looking great. You're profitable. That's awesome. Good job. And in reality, the economic model they have is not scalable. If that team leader starts to really grow their business, they are going to be stuck in production personally forever just to carry the financial weight of that team. That is not a business you want. Okay. So that leads me to the third lens. And that's what I want to focus on today with you is we have to look at our business through the lens of the CEO, our P&L. When we look at that financial statement, not how much can I deduct in taxes? What does it say my net profit is after I have all these personal deductions or whatever I run through my business. But instead, what do my margins say about the health of my business and my economic model? So I just want you all to come to the rest of the call with those glasses on, your CEO, CFO glasses on. That's what we're going to do here today. And the reason I say that, I want you to know the reason I say that, when you meet with your CPA, he or she is not going to look at it like we're going to look at it today. So they're going to be like, hey, everything looks great, when in reality, it may not, as I mentioned. And that's why it's important. This is going to be, as Colton kind of alluded to, I think I wrote on my notes here, 2023 exclamation point, because the market has shifted. We all know it's why you're on this call. Financials are going to be critical for those of us that are going to stay in business and be profitable and have time with our families. And so what I want you to do is see the 5 simple numbers in your P&L. So that's what we're going to go. There are 5 of them. The first one, we're going to just jump right into it. The first one is your total revenue. We're going to represent this as a pie. When you look at your business, I want you to look at it as though it's a pie. And the entire pie is made up of your total revenue. A couple things to note about total revenue. I see people get this wrong, and I want to make sure you guys have this right. Total revenue is total revenue. It's not what you have left after your broker took their portion. And that's one of the biggest mistakes I see CPAs and real estate agents make and team leaders make in their P&L is, if I did $1 million in GCI, but my broker took 200,000, well, hopefully it's not that much. My broker took, let's just say 100,000, and I'm left with 900,000. 900,000 is not my total revenue, but so often CPAs don't want to consider that 100,000 that gets paid to the broker in my P&L. And you have to, because it really is the true health of your business. It's really the true total revenue. So make sure that your CPA, your bookkeeper, whoever it is including the true total revenue. That's prior to anybody touching any of it.
And Andy, I want to kind of touch on this because we've seen, obviously now with some of the new brokerage models and revenue share programs, and even with Keller Williams and their profit share programs, including the revenue of those sources into their P&L. There was one agent who is absolutely massive. She's a absolute freaking rock star, and also makes a substantial amount of money in her rev share. And she was including it into her P&L until we did a webinar, and she's like, oh my gosh, yeah, that completely makes sense. It's a completely separate business. It has nothing to do with the true financial health of my business. I need to separate those revenues and I need to separate those expenses so that you can have true transparency into the actual revenue of the business.
100%. And I'm glad you mentioned it. It's probably the second biggest mistake I see is ancillary revenue being included in total revenue of your business, and it will skew all your margins. Right. So yes, make sure the way we set it up for people, and I think we probably do the books for the gal you're talking about, Colton, because I think I know you're referring to, but it's just at the bottom. It's additional revenue at the very bottom of the P&L. So if you have that type of revenue coming in, make sure that that's separate.
And when we talk about that, I think that's another good thing, because I know there's a lot of people on this call that do have some that actually have ancillary, and then some that have MSAs. Now, your recommendation for ancillary services, so a joint venture where you own part of a title company, or that's separate in your eyes, correct?
I mean, it really is. In my opinion, it's separate income. If you are a true owner of it, not just receiving referral fees from it, then it should really be a separate profit and loss statement.
Yeah.
But it just depends on the structure. And we can, for anybody, I'm happy to talk to anybody about their specific.
What's your recommendation for people who get mortgage money, and they get mortgage money, they get home warranty money, they get MSA agreements? Is that something that you would generally include into the revenue of the business?
Yes.
Yes.
Yes, because if you think about it, that's offsetting expenses. Yeah. And so we're using that money to offset what we would have spent on marketing ourselves, but we have these MSAs that are bringing in that revenue at the top. So I look at that as additional revenue. Yeah. Any inbound referrals from other agents is additional revenue, right? Because that was opportunity, but the revenue share from some of these things that we're seeing, different brokerages are seeing, obviously we want to not consider that because it can skew the numbers so dramatically.
In a really big way, for sure.
Yeah. And all of a sudden it looks like, wow, we're doing great. And we're not. If we pulled that out, all of a sudden we look at our team, the team is unhealthy and that is healthy. Same goes for if you are an independent broker. We have a lot of people that we work with that are independent brokers. They own the brokerage, but they also have a team within the brokerage. We have to separate those out. The brokerage could be just sucking the life out of the team financially, but on paper, it looks like we've got a healthy business, and vice versa could be happening as well. So we got to separate those out. So total revenue of the team of the business that we're analyzing here. So that's simple number one. Number two, this is the first chunk of the pie that we have to now cut out. And it's what's called costs of sale or costs of goods sold. You might have heard it referred to. At the end of the day, all it is the amount that gets paid out per transaction. So what this is for most of us is going to be our broker costs and our agent costs. If we have ISAs, we could consider, if we're paying them a split on every deal, we could consider that. So from the sale, is there a salesperson or entity that's paid from that sale? That's costs of sale or costs of goods sold. So, and it's really pretty straightforward. I mean, there's not a whole lot of ways you can mess this up. At the end of the day, if you have to pay something when a sale is closed and it's based on that specific sale, then it's a cost of sale. Another way to look at this is if you owned a restaurant and you sold a plate of food for $20 and $5 of that was the cost of the food. You didn't actually see $20 in revenue, you actually saw 15 because we had to pay the food vendor, whoever, that $5 for the food, right? And so that's the way to look at that there.
Now, if we can on this, because this is an area where, and I know there's different opinions on this, however, not having transparency into this piece of how I was running my P&L before, left me really vulnerable because what I wanted to do was get out of production. And as I got out of production, I did not, and I was not able to calculate the effect that that would have on my profit, because before what I would do is when I sold a home, all that money would stay into the revenue and I wouldn't pay it out through cost of goods sold. So say, for example, we've got Brian, he's our director of sales. Brian sells a home. That 50% or that 70%, depending on what type of lead source it was, is going to get paid directly to Brian. And it will be removed from the revenue and the net profit. You are dramatically inflating the profit. And this is one thing that I see one of our very good friends did $15 million in commissions. And he ended up saying on stage, he says, we run about a 19.96% profit margin. And I remember looking around the room and there was a ton of agents who I could just see that didn't understand it. We're like, oh my gosh, I would never in a million years work for a 20% profit margin. I have a 70% profit margin or an 80% profit margin. And it's like, no, first and foremost, he doesn't sell real estate. There is no production. One, he doesn't, but even if he did, he would pay himself the same exact way as agent. And I know the next number that you're going to bring up, I think you call it gross profit, gross margin is what it's going to be next.
Right.
So a lot of these people, for the next number that he's going to pull up is going to be your gross profit and your gross margin. So agents who are not paying themselves the same exact way that you pay your agents, a lot of those people are thinking they have a 80 or a 90 or a 95% gross profit margin. When the reality of it is, if you have a team lead that comes in and you generally pay out 50%, even if it's you that represents that client, I think it is so incredibly important that you separate your selling agent representation from the actual profit of your business. Because when you do step out of it and you replace yourself and you put a Brian in place and then Brian's representing that client, you've just had, and all of your financials and all of your expenses are based on, hopefully, what your numbers are, your expenses, your margins, the percentages that you're targeting. But when you implement that person and you're no longer representing it, all of a sudden you realize your team is costing you money, not making you money. And that is a huge exercise that I know we've uncovered with you and a lot of other teams that we've done this with, is when you remove the team leads production from the P&L and they make themselves pay themselves the same way that they do their agents, their teams are costing them money to run, not making them money. It's crazy.
Yeah, it's a fun exercise. I shouldn't say it's fun. It's an eye-opening exercise. It was for me. This is the thing that got me to pay attention and totally change my team model. that economic model I had, because of the same thing. I was losing 200 grand a year on my team. And I'm thinking, what the heck am I doing? I remember being on stage at a broker event, and people would come up to me afterwards and say, wow, you've only been in the business a few years. How did you do this much business and all these things? And I'm thinking, if you only knew the business I had, you wouldn't even want it. You wouldn't even want it, because you have to kill yourself and you're losing money on that production. So, once you get it tweaked and you make it right, then it's scalable, and then it gets fun.
Yeah.
But we've got to pay attention to that cost of sale. Now, if you don't pay, to Colton's point, the easiest way to get clarity on your true net profit is to pay yourself like you pay every other agent. If you've got a 50-50, 40, 30, 20, doesn't matter, split with your agents, but you do one of the deals, pay yourself that 20, 30, or 40, or 50%. For a couple of reasons. One is it's more fair to you, to be honest with you, because when you don't pay yourself, it ends up going into the bucket and you spend it on business expenses. I want to make sure that I have a much higher profit than that, 50 to 60% higher net profit if I'm not paying myself. And I'll talk about that as we go along in the final number here. But the third number is that gross profit. Very simply, it's a simple mathematical equation here. As you can see, it's total revenue minus what I had to pay out to my broker, my agents, my ISA, possibly myself, if I'm doing production. It's what I have left. And so the gray area here in this circle represents what I have left. Now, there's two things I have to do with that gray area. That's the money I have left. There's two things. I got to pay the bills, and then I got to pay myself. That's it. Pay the bills and then pay myself. So let's talk about paying the bills. That's simple number 4. There are 3 categories of expenses that whether you know it or not, you have 3 categories of expenses. CPAs and booking, they love to complicate expenses and have a million categories. And we look at it's all this stuff going on. And while I like subcategories, every one of those categories should fit into a primary category. So when you have them set up your chart of accounts and your profit and loss statement, they should all be around these 3 categories. Number 1, people. Number 2, marketing. And number 3, overhead. Everything you spend in your business should be in one of those 3 categories. And I ran a 30% expense model. So 10% on people, 10% on marketing, and 10% on overhead. That was my model. Others, it's going to be different. A brokerage that has really high splits with their agents can't have a 30% expense model. There isn't enough meat on the bone. They might only have a 5% expense model where they just pay for the office and the front desk staff or something like that. But at the end of the day, you got to decide.
Your numbers were again? What did you say your numbers were again?
Yeah, mine were 30% expenses. So it was a 10, 10, and 10. I just knew every year if I was running 10% on people, 10% on marketing, and 10% on overhead, I was running my margins. Because my total, not to get too far, but my total, if we go back to the total revenue, here's the model I ran. I ran 1/3, so 30%, 30%, and 30, or really 33. It was like 30 to 35% in each category. I had 30 to 35% cost of sale, 30 to 35% expenses, and 30 to 35% net profit and owner pay. And that's the model I ran out of production.
Yeah.
Now this is an important point. I don't want to get too far down this road, but I ran a different model, and there are different models you can run. I ran a very small team of 12 to 15 people, admin heavy, agent light. I had 2 listing agents and 5 to 6 buyers agents at any given time. We sold roughly 300 homes a year, 2 million in GCI, and I was able to exit production and maintain a 25 to 30, but ideally 30% net profit margin on that out of production. Other teams, as you can imagine, I mean, you're going to have a different model if you're running a different type of team. There are teams that have a lot of agents at a higher split with a lower net profit. There's nothing wrong with that, but it's just a different model. Yeah. A brokerage might run, so if we do this, if we just model this out like a broker, let's say you're a brokerage, this is why the brokerage models are dying, by the way, because there's no money to be made in them, because they'll have an 80% cost of sale, right? Or 85% cost of sale, because the splits are so high with the agents. They now have a tiny sliver of the pie to add value to the agents.
Yep.
They can take, even if they take a majority of that, they take 10% and they throw it at the agents. and they pay for a nice office, they pay for staff, and there's maybe a 5% net profit. That's a pretty common brokerage model setup. You got to do, if you want to make $1 million in this scenario, which is close to what I would net each year at a 30% net profit, you would have to do a $20 million brokerage at a 5% net profit. That's a huge operation to maintain a $1 million net profit. A lot of you may run a model different than mine, but also not a brokerage. It might be somewhere in the middle where you have a lot of agents. And so your cost of sale might be like, 45 to maybe 50%. And so you've got 45-ish, 50, maybe 55 at the most left to work with. And then you'll spend 30. So you might have a 15%, or maybe 20, I guess, if I'm doing my math right there, net profit. There's nothing wrong with that model either. You just got to be clear on what model you're building.
100%.
Right? And that's the key here. What model are you building? And are you tracking correctly?
And I see, and you see it 10 times more than I do, but in the conversations I have, most people are targeting a 20 to a 25% profit margin. Yep. And so in that case, if you want a 25%, it's a 40% cost of goods sold, which means you're only going to have 35% left for expenses. And then you got a 25% profit. And I've heard these conversations. Our buddy Dan Beer, he's like, yeah, you guys can pay your agents more money, but you're not going to be able to have the staff that I do, and you're not going to be able to have the integrator that I do, and you're not going to be able to have the building that I have, and you're not going to be able to have the systems that I utilize and the marketing that I'm able to spend money on to create more opportunity for the business. Having the actual numbers and the expense portions of your revenue dialed out to ensure that you're keeping it on track to at least be able to hit that revenue. I've had friends truly that have started using Andy, thought they were profitable, and by the time they were done, realized that their businesses were costing them hundreds of thousands of dollars a year to run. It's so reckless not to have transparency into it.
Yeah, and that's where the P&L comes into play. Just make sure you're reviewing it regularly. Make sure you've got your model. What are you building for your model? And then how are you doing each month, quarter, and year? But I think keeping it simple, right? And that's why we come up with the 5 simple numbers. Like I don't have time to analyze my P&L like a true CFO would, somebody who's gone to school for that and understands it at a deep level. I need to know, what are my 5 simple numbers and what are my margins in between each, and how am I doing? Am I running a 30% expense? Am I at 10% people, 10% marketing, 10% overhead? Or am I way over, or am I way under and I have room to add? What does it look like? And so that's simple number 4. And again, just to clarify, people are any staff type people. These are not your agents. Do not put your agent splits under people expenses. I've seen that, and it's not where it should be. I've seen CPAs and bookkeepers that don't understand real estate put that there, or not included at all. So people are your staff, your salaried hourly people. Now, if you pay yourself, is this where you're going to go to? Is pay yourself a salary?
I was going to ask, well, no, that's the perfect next topic. I was going to read you a question that Lee asked. Oh, she said, is my stock contribution included in cost of goods sold, or that's removed from revenue?
Removed. That has nothing to do with your business. As far, what that is, Lee, and it's a great question because I see this a lot, because the world of real estate has changed. You can actually buy stock at a discounted rate through your brokerage. That's awesome, right? That is an unbelievable opportunity that we never had before, but it has nothing to do with the health of your business. Yeah, that should be at the bottom of your P&L as an additional expense, separate from your real estate expense.
Yeah.
And obviously the reason is because it has nothing to do with the health of your real estate team or business there. What it is profit that you're choosing to use to buy stock. Totally fine. But has nothing to do with your expenses in your business. So
or even if it's the free stock awards that you get through all the multiple different channels, it's all the same thing and it's separated.
Right.
So other than paying agents commissions, what is another example of cost of sale? Paying a commission to an ISA? Is it really just commissions?
Yeah, for the most part. I mean, I've seen some different things that we've decided to put into cost of sale. And there's really no right or wrong way to do this, but you just need to make sure you know what you're putting in there and that you've accounted for it in your in your economic model.
If you pay a 25 or 30% referral fee to Homelight, would you consider that cost of sale, or do you consider that a referral expense?
This
It's
is
a
the
great
debate.
question. Yes, I love that we went here. I wasn't sure if we would or not, but it's becoming more and more.
It's where I was going to
important.
take it next.
Okay, so let's park here under expenses for a minute. There's one more obviously simple number we want to discuss, but around expenses under marketing, and remember that's marketing and lead gen. Any dollar you spend to generate an opportunity for your team should be categorized under marketing and lead gen. To answer your question, John, it doesn't matter where you put it. Some people don't even put it on their P&L. So for example, let's say Homelight or Zillow. Let's say you do Zillow and it's a 35% referral fee to them. Some people, and it's totally fine to do this, don't even include that in their total revenue. I know earlier I said you got to include all this stuff in your total revenue, and I think you do. But it's okay if you don't, as far as these referrals to these outside businesses, because the mindset there is, well, I didn't have the actual money to begin with, so therefore, why would I look at it as revenue? Totally legit point, and you can set it up that way. Here's where you get into trouble: it's when you go from paying a monthly fee to Zillow. We were paying like 11 grand a month to Zillow, and our team. And I was running a 10% along with other expenses in marketing. We were doing other things in marketing. We did a lot of radio, TV, billboards, but 11 grand on Zillow. And with all of the marketing I did total, I was running 10% marketing expense. So then the next month, Zillow called and says, hey, Andy, guess what? We're going to get rid of the 11 grand a month and we're going to go to a 35% referral fee. And so I say, awesome. I'm not even going to include that, or I'm going to put that in cost of sale. And now my brain says, now I can spend 11 grand a month on something else. And that's where we get in trouble.
Yeah.
Because that money didn't just disappear. We just are now, instead of paying it monthly, we're paying it in a referral. So I like to still include that as a marketing expense. I want to know how much Zillow got off of me. Because if you think about it, those deals could have been done somewhere else. Maybe we could have spent that time and energy at an open house or through our sphere of influence or whatever. Instead, we're over here doing a Zillow deal. And it did cost us 35%. I want to know that opportunity cost.
Well, and that was because I know for us, I know Dan Beer runs it this way. And it's funny because Andy is a very good friend of my real estate coach. And of course, we've got Dan Beer and we've got Kyle and we've got all these people who spend a fortune in referral fees. And we're like, where do we park this money? And in the very beginning, like Andy and I went back and forth and like, is it an expense? Is it a cost of goods sold? Is it and I landed on where Dan Beer did. And I heard Dan Beer's argument. He says, it's not revenue we received. If I'm in a joint venture, which I am in multiple, I never count their money. Therefore, I remove it from the revenue. So whether you put the referral removed from the revenue, which is what we do, it's what Dan Beer does, or you put it in cost of goods sold, or you put it in marketing, the profit's the same. But the part where it gets screwed up is when you budget and allocate 10% for marketing, 10% for overhead, 10% for people, and then you just completely remove it from the expense and don't count it in the mark. You can't spend 10% if you're trying to maintain the same profit margin. So if your goal was to spend 10% in marketing and now you're going to remove it, now we've set ours where we want it below 7%. And that's how we've adjusted to ensure that we're keeping our margins and that we're keeping our percentage allocations the accurate way. Eric disagrees. He does it one way. He thinks it has to go in cost of goods sold. Right. I know you prefer that it stays in expenses, and Dan Beer's way is remove it from the revenue. It all ends up with pretty much the same net profit, but it's how it can skew your numbers if you don't adjust that 10% marketing budget, because you still can't go spend 10%.
Yep, agreed. And really, like I said, John, the only time I see it become a major issue is that when we shift, when we go from the monthly to that 35% or whatever it is, and then people think they have more money to spend. That's where we can mess this up. Okay, fifth simple number is net profit and owner pay. Obviously, that's the green. That's what you have left. So you can very simply see when we look at your profit and loss, we look at your business like a pie. Like, it's pretty basic. This isn't terribly complicated. You've got your total revenue. You subtract the yellow area, that piece of pie, your cost of sale. You subtract, it leaves you with your gross profit, which is the red and the green area together. but then we have to pay the bills. So that's the red area. What we have left is net profit. Now, I always like to look at this as net profit and owner pay. Why? Because not everybody does what Colton was talking about before. Usually I see 3 ways that agents pay themselves when they're the team leader. They may pay themselves a split like their agents. They pay themselves a salary, and they get paid net profit. I don't care how you do it. Honestly, guys, I don't care how you do it. It doesn't matter. Because if you think about it, if this green area right here is net profit and owner pay, it doesn't matter how you slice that. It's all your money. You might slice it that a portion of it is, this portion is commission. And then you also pay yourself a salary. And then this portion that's left is your true net profit. Maybe that's like, okay, let's say it's that. Let's say that you have a 10% net profit, but you also about 10% of your revenue is paid in a salary, and then you're getting about 10% of it in net profit. You run in my opinion, you run a 30% margin company, because with your what you paid yourself, with your salary, and with your profit, you have about 30% dollar. Now, the challenge is if you want to exit production, it's going to screw you up a little bit, because you're going to exit, and all of a sudden this 10% you were paying to yourself in commission is now additional cost of sale. It's now part of this column, and you went down to 20% net profit, just like that. And that's where we can get in trouble.
And I think this is because there's not a right or wrong. Like, for example, I personally remove, I think it's absolutely necessary. Well, because I didn't do it, and I found out that I wasn't profitable, and it took us time to correct it and get back that way. And when I wanted to remove myself from production, that's fine. But I also pay myself a salary as a CEO and the team lead of the company. Now, my plan and what I will do is I will remove myself, and I will no longer be the CEO and the team lead of the company, and Brian will step in. But now I got to pay Brian that salary.
Right.
And now I've taken another unexpected hit. So like, if you really want to see the true transparency, the only thing that would happen, like for us, if that's your plan to get out of production and for you not to continue running the team, in which I know a lot of the people on this call, that is ultimately what their goal is. You just have to be very conscious of where that salary will go. Is Brian going to take over? Are you going to have somebody else take that over? And can you live on whatever that profit is that's left? There's not a right and a wrong. It's what you're building and what you're aiming towards that's going to tell you what area you need to put all of these categories in, and where you count net profit and where you don't.
Yeah, I couldn't have said it better, in that you've got to know what your model is. And so for Colton, what you're saying is a portion of this, when you were still in production, a portion of your cost of sale was your production.
Yeah.
And then a portion of your expenses was your salary.
Yeah.
And so then you really saw your true net. You could easily replace somebody else, a different person in that salary, and it's there. The money's already there. Your net profit doesn't change.
Exactly.
Same with here. You could replace somebody in those deals, and your net profit doesn't change. And so that's huge, and it's key if you're gonna be really clear on the health of your business. Now, here's where, in the reality of, is that I see a lot of team leaders pay themselves a salary. I would imagine almost everybody on this call is a S corp of some kind or whatever, and you're paying yourself a salary. Why? Part of it, there's 2 reasons why you do it. One reason people pay themselves a salary is because they may replace themselves one day in the business. Totally fine. Great. If that's your plan, as Colton said, make sure that you account for that in the salary, because that money you're paying yourself eventually will have to go to somebody else. However, from all the teams I've coached and worked with throughout the years in different capacities, very few actually end up doing that.
Yeah.
If I'm being frank with you. Even I would go in on Tuesdays and run our team meetings. I was still heavy in marketing, and I was still the CEO of the business. And I was at the 7th level. To me, it was like, why would I pay somebody that salary when it takes me 1 day a week? I enjoy doing it anyway, and I don't have to be in production. It's great. But for some of you, you may. So you need to do that. The other reason, and probably the more common reason, is to keep the IRS happy. Your CPA will advise you. You need to be paying yourself a market-based wage. And so that's why we do it. And if that's the true reason, that's why I like to include that in net profit, because if you really think about it, it really is your money. You just have to pay it in the form of a salary versus a profit distribution at the end of the quarter.
Yeah.
But so these will be distributions. You'll pay yourself a distribution out of the profit, and you pay yourself a salary out of there as well. If that's the reason you're doing it, I think it's okay to just kind of leave it all together over there. But at the end of the day, you just need to make sure you know what your margins are.
And that's one of the reasons that I think it's so incredibly important, that because I'll hear people, and when you talk about like a 30% profit margin, and we talk about 35% profit margins, if you're paying yourself a salary, if you're paying yourself out through cost of goods sold, that's a really, really, really hard profit margin to hit. If you're truly paying, it's the same thing. Now, at the end of the day, the way Andy's running it and the way I'm running it, we're both walking away with the same exact money, regardless of how we run the P&L. But where this completely gets screwed up, and where I see people's mindsets get screwed up, is they hear somebody saying, I'm running a 30% profit margin or a 35% profit margin, but then they're not paying them, but they're not paying themselves the salary, and it's not being backed out through the revenue. So then you see people comparing your profit margin to somebody else's profit margin who's running the P&L completely different. And you're either pounding your chest because you think you're the king of the hill, or you're cowering in the corner thinking you're running this terrible, horrible business. And it's like our buddy, Dan Beer, when he got on stage and said what his is, he pays himself a huge salary. And I'm not speaking, he spoke this on stage and he does all the time. He pays himself a huge salary that's removed from the revenue and from the net profit. He pays himself as the head of the roles that he runs. And then, of course, he's not in production at all. So like his net profit is a real business. It is the real, to where that person, if he wants to replace himself in the business, he can, and his profit doesn't change. But I see people comparing apples to oranges, and I know you do, Andy, on a daily basis. And it's just not fair, because there's certain people that think, oh my God, I'm running this terrible business, when they're comparing it against somebody who's running it the completely inaccurate way.
Yep, 100%. We can make the numbers look however we want. So
Colton, just to recap, it sounds like based on what Dan Beer's doing, what you're doing is you're including the money that you pay yourself in the expenses, not the net profit.
Correct. My salary is paid in expenses, because at some point my ass is leaving California and Booney's going to run the company.
So that's your salary. But then at the end of the year, if you have a great year and you do a draw, you're doing that out of expenses as well, or
whatever's left at the end is what I'll transfer. I'll either choose to keep it in the business and keep it as an asset, or I'll choose to do a distribution.
Got it.
And that'd be out of profit. It would be a profit distribution in the eyes of the IRS.
Yes.
Again, in my eyes, it's all out of the green bucket.
Yep.
It's all green money. It's all coming out of the green bucket. So again, what is your business model? What are you planning to do with your business? And how do we want to set this up so that you can win? That's what Colton's saying for sure, is like, just be clear on what you're doing. That's the biggest mistake I see people make, is they don't know. And then at the end of the day, they look and say, oh, it is what it is.
Yeah.
That's where we can just waste all of our time and energy and effort.
And if you're building something to where you're ever going to do a profit share model, you have to separate out your personal commissions, because then you're going to share in profit for money that you should have been paid as the selling agent. It is and again, we only figured this shit out because it was like, this is how we were doing. We opened up a profit share, and I'm like, well, shit, my production's helping the profit. I have to pay myself the same exact way as if this was a traditional agent. And this is why I personally do feel, if you have the plan to evolve your business into a fully operational business that functions and operates without you, it's really important to run it that way.
You know, it's probably pretty obvious at this point, but I do want to talk about quickly, like, where does it go wrong? What I love about the 5 simple numbers approaches in setting up your P&L is that there's only 2 places you got to look once a month to see if you're on or off track.
Yep.
Did I hit my numbers for cost of sale? Check. And did I hit my numbers for expenses? Check. Those are the only 2 places you can mess this up. So you don't have to go digging super deep to know if you're on track or not. So here's an example. Here's a pie. Here's an example where, you know, the cost of sale is quite high. And if you were running my model, I'd look at this and say, that's too high. I got to change something. It really comes down to, I got to change my splits. I got to do more team leads versus SOI leads, because I have a different split on those. I need to shift to more listings versus buyer leads, because that'll reduce my cost of sale. I need to implement an admin fee, because that'll go to the company and reduce my cost of sale, increase my gross profit. Like, there's things you could do to fix that problem, but we got to know that we're on or off. So the first thing is, are we off track with the cost of sale? In this model, if I was looking at it compared to what I wanted to run, oh, Andy, your cost of sale is too high.
Yeah.
That's a problem. I need to go fix that. The second thing, the only other place that could be an issue is, the second thing you can get wrong here is your cost of sale might be fine. But as you can see in this model, I'm spending 50% of every dollar that comes in on expenses. I'm going nuts. Most of the time it's on new fancy lead sources, or I'm overpaying my people, or I have too many people for the amount of production I'm doing. Whatever it is, my expenses are way too high. And obviously my net profit and owner pays is way low. So you got to be aware of that. Expense is too high. And then obviously the worst it could be is if you get them both wrong. And I see this sometimes where our splits and things are wrong with the agents and we have a really high cost of sale, or we're doing a ton of buyer deals and our splits are higher on the buy side than the listing side. So our cost of sale is too high or whatever. And we're overspending. And if that's the case, it really eats at your net profit. So if your net profit is not where you want it to be, it's because either your cost of sale is too high, your expenses too high, or both. So that's what you need to be looking for.
And what's great when you run it like this, and Andy, I'm so grateful that this year we were running it with you, because all of a sudden, like we were pretty lucky to where we didn't feel the effects of the market until end of October, early November. But holy shit, did we take a gigantic loss in November. And December, we were able to mitigate against that a little bit, but we still took a small loss. And it was like the amazing thing was when we were really running this the right way, and when we were looking at our leading indicators of what revenue would be come January and February, we immediately went back to the P&L and we said, this is the exact percentage of expenses or people that we need to cut in order for this to continue being profitable. And we immediately cut like $20,000 a month in expenses. And we added an extra $15,000 in revenue through an ancillary service. And it was like, boom, we're back in good shape. But if we didn't have transparency into these numbers, you don't have the ability to pivot. You don't have the ability to identify the exact amounts that you need to be cutting to ensure that you're still staying on track. And you're guessing and you're making decisions based on your gut. And if you're anything like me, your gut is going to allow you to be way too generous on expenses. And it's going to allow you to be way too generous in salaries. It was the best thing in the world that we had you at that time where we said, holy shit, this is going to be a problem if we don't do something now. Mm-hmm. And it gave us the ability to quickly pivot, quickly adjust to where January, we're going to be fantastic again.
Right. And what I love about it too, Colton, is that it also helps, while it helps you know if you're on or off track, it also gives you permission.
Yeah.
In your business.
Red light, green light.
Red light, green light. It's like, can I do that new lead source? Well, let's look. Where am I at? Nope. Red light. Gotta wait. Or green light, ready to go. And it frees you a little bit there. So.
My integrator today, when our leadership team was together, we're having a good problem and we're not answering our leads. It's like, well, can we add an ISA? I immediately said no. The reason I immediately said no is because we're in a red light category right now for that particular category, and I'm not going to make that higher until I'm in the green light. And as you start dipping below that, like what my coach calls it, it's red light, yellow light, green light. When can you stop? When do you need to be cautious? And when are you free to go? And I've gone to Eric multiple times and I'm like, I don't know if I can afford this person. He goes, yeah, you can buy it. Yep. You're in the green light. But the minute that the market starts shifting and you realize, shit, I need to slow down, because if I don't, and if I make this decision based on gut, all of a sudden you're at a huge loss. It is the most important piece. I don't care if you're a solo agent, a gigantic team, a small team, a micro team. It doesn't matter what you are. I wish I would have seen the importance of this as a solo agent, because even those solo agents who are on teams, you guys should be running profit and losses, because you should be reinvesting into your own business, and you should be reinvesting into creating your own brand, and you should be reinvesting to create something for yourself. But you're never going to be able to do that, or you can, but you're not going to be able to do it with financial intelligence to where you can make the decisions based on the actual financial health of your business.
Andy, what's the rationale by taking, because I was always taught, I think, that people would go under overhead. Why do you separate those two?
Well, because people is people and overhead's overhead, I guess, is the way I see it. I'm not sure why you would put people in an overhead category. It depends on what you were told is overhead. Maybe there's a different definition someone has.
Ask it a different way. What is overhead if it's not people? Like it's
It's
your
any-
rent, it's your utilities, insurance.
Yes, here's my definition of overhead. Anything that isn't a people or a marketing and lead gen expense.
Yep.
Everything else is overhead. So examples of that are the things you mentioned: office rent, office supplies, travel,
Food, events.
yeah, meals, even anything that isn't a person you're paying a salary or hourly rate to, or that isn't designed to generate a lead.
Yep.
It's an overhead. Client events, that's marketing and lead gen. Because the whole point with it is to generate opportunity, in my opinion, right? So there's a lot of room to move these around. I just try to keep it as simple in my own business around 10, 10, 10, and then a nice even approach, easy to understand, easy to know if I was on or off track. And, I kept it that way, but I think those are the three categories. The other thing I want to touch on with this, guys, because this is coming up right now around your taxes is, and I don't want to overcomplicate I don't want to overcomplicate this for anybody I want to avoid overcomplicating it. But I want to talk briefly though about expenses in direct versus indirect expenses. Because come tax time, here's the thing, you're going to want to run as many expenses through the business as you possibly can. At least that's some people's approach. A lot of those expenses are personal. For example, your car. You got a fancy car, you bought a really nice car, and you're running through the business. Totally fine. Totally fine if your CPA says it is. But that's not really truly a business expense, especially if it's a super expensive car.
Yep.
Right. And so we need to make sure that some of those expenses we're running through the business, when we look at it through the eyes of a CEO, we're pulling that stuff out. How do we do that? Very simply, to be honest, your bookkeeper or CPA needs to run direct and indirect expenses. All we're doing is in your profit and loss statement, like I'm showing you here on the screen, instead of just having one column that just shows all your expenses, we split your expenses into 3 columns. One is your total, and it's not showing it on this screen, but I'm just writing it on here. One is your total expense. That includes all of the expenses you're running through the business, like your real business expenses as well as your personal expenses. Why? Because the IRS, from the IRS's perspective, we want to keep your net income as low as possible because that decreases your tax liability, right? But when you look at it, when you look at that column and you're trying to look at your business from a health perspective as a CFO, it lies to you because it says you didn't make any money. Yeah, we want the IRS to think we made no money, but we want to know how much we actually made. And that's why we also have to do an indirect column and a direct column. Those are the other 2 columns we want on your P&L. Because indirect's going to show you what you ran through your business for personal expenses, my car, my health insurance. Maybe I ran a bunch of vacations that really weren't business vacations, but I ran them through, meals that I went on or that I spent money on. Those are all indirect expenses. I want to know how much I ran through the business as an indirect expense. And then the third column is going to show me what were my actual true business expenses. And I think when you're looking at your P&L with your bookkeepers or CPAs, you need to understand, like we talked about in the beginning of the call, the 3 lenses and that you're looking at the right column.
Yep.
The good news is whether we do your books or somebody else does your books, all of the simple numbers are in your P&L. And maybe you can work with your bookkeeper to clean them up a little bit, but at the end of the day, I could look at anybody's profit and loss statement today, and we could find your 5 simple numbers in there. So all of this is in there. It's all in there. Don't overcomplicate it.
Yeah.
Okay.
And
I think that's really, that's really all I had to cover here, unless there were any other questions.
And if you want to, guys, are you done with your?
The only other thing I'll say is if you need a budget tool, some of you have really nice budget tools, fancy budget tools. That's awesome. If you need a simple budgeting tool for this year, 2023, go to that website, 5minbudget.com. And I have a 20-minute video that I explain how to complete it, and then a free download for an actual PD or Excel spreadsheet. Once a year, it would take you 5 minutes to complete this thing. And you will have a budget by month, quarter, and year.
Yeah.
Around all of these 5 numbers. So then hopefully you could use that each month with your CPA or bookkeeper and look at your actual profit and loss statement and compare and say, am I on or am I off track? I set the budget. Now, how did I do? And so we work with a lot of our clients to use that tool to just keep it simple. And then in the future, you can always go deeper, but that's a good start. Somebody had a comment, you work on a website for a P&L template. No, I mean, obviously I recommend if you don't have a good P&L template, you work with someone who has one, because, and that needs to be real estate specific.
Yeah.
That it's why we only work with real estate companies, because your P&L template, which is also referred to as your chart of accounts, needs to be real estate specific.
Normal bookkeepers have no clue how our business is run. And they give you advice on how to run your P&L, and it's just a wildly inaccurate representation.
So, I mean, if I have a CPA and I have a bookkeeper, and I'm sorry if this was obvious and I missed it, what is Simple Numbers? What's the service that you would offer? What's the service that you provide Colton with? Like each month you're looking at his numbers?
No, we are bookkeepers. We do your books. We set up your chart of accounts the way that we think they need to be set up. And then you consult with me as part of our, basically we charge what most bookkeepers charge. You just get me included. And it's for me to help you stay accountable and look at your P&L once a quarter. We do payroll. I help people implement Profit First. We are Profit First professionals. So we've been trained by them to help you, which I'm a big believer in that as well. If you don't have that in place, check it out. And so we can do a lot of different things. We don't do tax advice, so you still need a relationship with a CPA. Most people find their CPAs are really expensive when it comes to books, or it takes forever to get their numbers. They don't get them regularly. We guarantee all of our clients get the books within the first 14 days of every month. So that's if any of that is needed, then we can help you with that.
QuickBooks Online, is that what you use?
QuickBooks Online only. That is the only ones we use. If you are using desktop, we can convert everything to online.
How do we contact you to get in contact with you to initiate services?
Yeah, best way is simple-numbers.com. I can put it in the chat. And then, there's videos on there too. If you want your bookkeeper to look at some of those videos, have them go to the website, go to our vlog, and I'm always adding to it. But there's some good tips in there on how to set things up. But or there's a place to get a quote from me. You can schedule a free consult with me. If you want me to run through your P&L with you, I'm happy to do that. Tell you what I think. But yeah,
in my personal opinion, one, Andy, you completely pay for yourself, because when you actually have a budget to run and you understand the percentages, the profitability that will create for you when you start making smart instead of stupid decisions, it beyond pays for itself. If anybody wants, because this is an area that I struggled with majorly, this is actually from my real estate coach. This is not the exact model. It's different for everybody. If you pay yourself a salary and you remove that and you put that in expenses, and if you're removing your cost of goods sold, a 25% profit margin is more difficult to maintain. But this shows you, if you're trying to get that 25% profit margin, what percentage can you spend on auto insurance and gas? What should you be aiming to spend on education and coaching? What should you be aiming to spend in insurance and entertainment? Now, these are all just expenses. It's all included in his one simple number, but it's where are we overspending? And for us, when we had to remove when we removed flex from cost of goods sold and we removed it from expenses, I now had to make it so I'm no longer going to spend 9 or 10% on lead generation. I'm now only going to spend anywhere between 6.5 to 7. So when you actually have the targets outlined, it gives you the ability to just make smart decisions. Andy, thank you so much as always. Thank you for all you do. Appreciate you doing this. I think it's one of the most, it's not focused on at all in any way, shape, or form, and it needs to be a lot more. So thank you so much for everything you do, brother.
Thanks for having me. Good to see everybody.
Thank you very much, man.